Economic Crisis in India, 1991, World Bank and IMF. In 1991, India experienced a classic external payments crisis. High fiscal and current account deficits, external borrowing to finance the deficits, rising debt service obligations, rising inflation and inadequate exchange rate adjustment. The reasons why the crisis occurred were: in 1979, the oil shock, agricultural subsidies and a consumption-driven growth strategy had pushed up the fiscal deficit. It further increased in the mid-1980s as defense expenditure was substantially increased and direct taxes were progressively reduced. Increasing dependence on foreign oil imports, vulnerability to oil price fluctuations, declining remittances from abroad, strong domestic demand, a result of public sector wage increases in the mid-1980s. Rising debt service payments ensured that the current account deficit averaged 2.2% of gross domestic product or GDP during 1985 to 1990. Hence, what happened was, to finance the twin deficits, India relied on external funds. Foreign investment at 0.1% of GDP during 1985 to 1990 was negligible. During 1980 to 1985, nearly half of external financing needs were met by external assistance. By the mid-1980s, aid weariness forced the government to rely more on commercial borrowing. Soft loans declined in proportion from 89% in 1980 to 35% in 1990. Thus, external debt, with a large proportion of short-term debt, started dominating the balance sheet, peaking at 38.7% of GDP in 1991 to 1992, with the debt-export ratio at 563%. The then new Finance Minister, Manmohan Singh, said that India must face the harsh realities of a changed world. That excessive bureaucracy and controls had damaged the nation's economy, that foreign investment would be sought, and that India must face the realities of failed policies. He demanded no ideological hang-ups and contrasted India to South Korea. The two nations had the same per capita income in 1956. But we have fallen way behind, while South Korea has emerged as an economic giant, he said. Between July and September 1990, India drew $660 million from its reserve tranche in the IMF. By the end of 1990, when reserves could cover only 3 weeks of imports, India negotiated $1.8 billion under the Compensatory and Contingency Financing Facility or CCFF and the first tranche of a standby arrangement. The CCFF, an emergency measure, imposed little conditionality, but the government took harsh steps to suppress imports. The IMF was approached to underwrite the reforms. Under the CCFF agreement, India had already withdrawn $221 million in July 1991 and $637 million in September 1991. Since stabilization measures would take time to rebuild reserves, the RBI estimated $3 billion was needed to undertake reforms without undue disruption. In 1996, the IMF calculated that East Asian countries had balance of payments or BOP crisis probabilities ranging from 25% for the Philippines to 65% for Thailand. India's probability was just 11%. But as in 1990 to 1991, India was again experiencing political instability. A minority coalition government twice lost parliamentary support of the Congress Party during 1996 to 1998. In May 1998, the two-month-old BJP-led government engineered nuclear tests, inviting widespread sanctions. Fresh commitments from the World Bank, Asian Development Bank, and bilateral donors ceased. Credit rating agencies downgraded India, and foreign institutional investors withdrew funds. Officials said that it would be the biggest loan the IMF had ever made to India, and that it would hinge on a set of conditions, demanding that India reduce its budget deficit, open its markets to foreign competition, diminish its maze of licensing requirements, cut subsidies and liberalize investment. In the summer of 1991, with dwindling foreign exchange reserves, India considered 4 options. There was a strong temptation to default, but this was no recourse. The second option, seeking private funds, was also unrealistic. A third strategy was to pawn gold. The measure had the merit of signaling India's credibility. But India's problem was not temporary. It had to shift away from recurring liquidity squeezes. Some interesting facts. One of the defining moments of the crisis of 1991 was the decision to send out gold from India as security for a forex loan. What the pledging of gold did to the foreign exchange situation was to bring in about $500 million, a large sum those days. More important, it helped alert the national psyche about the catastrophic situation in which the economy was. It became clear that the extreme solution of going to the IMF was unavoidable. India and the IMF. Between July and September 1990, India drew $660 million from its reserve tranche in the IMF. By the end of 1990, when reserves could cover only 3 weeks of imports, India negotiated $1.8 billion under the Compensatory and Contingency Financing Facility, or CCFF, and the first tranche of a standby arrangement. The CCFF, an emergency measure, imposed little conditionality, but the government took harsh steps to suppress imports. The IMF was approached to underwrite the reforms. Under the CCFF agreement, India had already withdrawn $221 million in July 1991 and $637 million in September 1991. Since stabilization measures would take time to rebuild reserves, the RBI estimated $3 billion was needed to undertake reforms without undue disruption. India's letter of intent of August 1991 outlined its own proposals for policy reform. By November, a standby arrangements promised $2.3 billion over 20 months. There was also an expectation of concessionary loans under the Enhanced Structural Adjustment Facility. And the Aid India Consortium pledged $6.7 billion with another $7.2 billion for 1992 to 1993. In December 1991, the World Bank approved a structural adjustment loan of $500 million. Another $900 million was raised to support social safety net programs, and in June 1993, it gave $300 million to support external sector liberalization. In 1997, the bank engaged in policy discussions with individual states, with state-level adjustment lending becoming an important part of the portfolio. And a chartered plane ferried the gold to London between 21st May and 31st May 1991, jolting the country out of an economic slumber. The move helped tide over the balance of payment crisis and set rolling the juggernaut of economic reforms that unshackled the caged tiger. The Narasimha Rao government ushered in several reforms that are collectively termed as liberalization in the Indian media. The forex reserves started picking up with the onset of the liberalization policies and peaked to $314.61 billion at the end of May 2008. It touched $295.792 billion for the week ending October 8, 2010. Consequences and conclusions. The banking system did not have overseas liabilities, nor did private entities owe large sums to international creditors. Foreign institutional investors did not lose money on their investments. The consequences of the pressures in the 1990s on growth and poverty in India were more complex. Relative to the 1980s, average incomes grew faster during 1990 to 2003, 4% annually. In the immediate aftermath of the 1991 crisis, critics pointed to rising poverty incidence. And the poor suffered from double-digit inflation during 1991 to 1996 due to a combination of factors: import constraints, weak agricultural growth, cuts in subsidies, and inadequate monetary sterilization. But overall, poverty fell from about 37% in 1990 to about 26% in 1999 to 2000, though adjusted estimates show the decline was more evenly spread since 1987. However, the rural-urban poverty gap increased, thanks in part to sluggish agricultural growth of only 3.2% during 1993 to 2000. Furthermore, the dynamism in the services and manufacturing sectors was concentrated in the south and the west, whereas jobless growth meant that poverty rates continued to exceed 60% in parts of Bihar, Orissa, Madhya Pradesh and Uttar Pradesh. The crisis also affected social sector spending and outcomes. Although allocations rose in absolute terms, the rate of increase slowed until 1997 before picking up again. Central and state spending as a percentage of aggregate public expenditure declined slightly in the first half of the 1990s but rose after 1994 to 1995. The inability to substantially widen the tax base and narrow the black economy meant that public funds for social sectors remained constrained. As a percentage of GDP, social expenditure did not increase in the 1990s. Finally, a bigger question is whether structural reforms can really be separated from emergency stabilization measures. Structural reforms in India, privatization, industrial policy and trade policy involved several competing interests, which have not been discussed in this article. But these issues have been the more contentious for India's political economy. In some ways, the absence of rapid privatization, excessive short-term borrowing by banks, or liberalized capital flows served India well when financial contagion was sweeping its neighboring regions. At the same time, several minority governments survived and technocrats ensured continuity of policies across administrations. A democratic gradualist path to structural reforms increased India's immunity. As India integrates more closely with the global economy, reserves are now over $150 billion. Further policy changes might be in the offing, and they will continue to test the balance of institutional and political power of new and old interests.